Just so our viewers know, this is 40% bigger than your prior fund, your largest ever, $4 billion away from being the largest fund raised ever. I mean, we had it in the intro there. It's been said that this is one of the most difficult environments for fundraising. So are the people that say that wrong?
No, I think it's been a pretty difficult environment in the past few years. There's not been as much liquidity that's come back to limited partners. And so I think their ability to deploy new capital in private equity funds has been more limited.
So what's the secret sauce then? How are you able to do that? I mean, the stats I have here, Raymond James says that in 2023, private equity returned the lowest amount of cash to investors since the great financial crisis. So how do you raise a record fund in that environment?
Yeah, so we're really pleased with this outcome. I'd say there's really three things that led to this outcome for us. The first is performance. I think performance really matters in all markets, but particularly in markets that are a little bit more choppy. I think we've demonstrated the ability to generate performance across all sectors and geographies in which we operate. I think the second thing is our differentiated approach to investing. I think relative to other, some more traditional private equity firms, the way we invest and how we interact with our companies is quite a bit different, and I think that matters. And the third thing also is that our limited partners, we've been around for 30 years as a firm.
Right.
A lot of the institutional investors that have invested in our fund have been with us for a very long time. They're quite loyal to us as a firm. We treat them as partners, and they view us as partners as well, and they want to see us successful.
I mean, Danny and I, we were chatting about this discussion with you this morning, and the one thing we want to understand is there's this gap, the gap between the buyers who don't really want to pay up because they're potentially facing a recession. I mean, this is between the gap between the buyers and the sellers who paid a lot for assets, but they don't want to sell at a loss. I mean, are we reaching an inflection point of where there's a break in that? Is there are you coming closer together? Yeah. Is the marriage getting better?
Yeah, so I think it depends on the company. So if you look at it, in any market, there's always going to be a gap between buyers and sellers at some point until the transaction occurs. I think what's happened in the past years is valuations increased really almost nonstop between 2021 and kind of middle of 2022 for a given asset. You know, people paid quite a lot for, you know, the same asset they would have a few years earlier. But for the really good companies, particularly ones that are growing, they can grow into their valuations over time. And so maybe the average holding period for a private equity investment prior to, let's say, 2011 might have been 5 years. In the last few years, it had really shrunk. You could hold assets for 2, 3, and 4 years and still achieve your targeted rate of return. I think what we're seeing now is it's going back to being slightly longer holding periods in order to deliver the multiple of capital that you need on the same investment.
Could the gap also be solved, though, with valuations coming down? Because that's one of the things you said is valuations were higher and that made this difficult. Could that be the solution? And is that likely that we do see a period, be it recession, be it macro stress, that valuations come under pressure?
Yeah, it's funny. It's a little bit like the real estate market, right? So let's pretend you have a whole bunch of houses on the same street. People always remember what their neighbor's house sold for. And so if they don't have to sell, they'll just sit on it. And so what we've seen is that the buyer-seller gap, it doesn't close. It just, you see fewer transactions. But over time, as companies grow into them, then the companies will...
I was worried about that metaphor because people are worried about commercial real estate right now. I was like, where are you going with this, Eric?
Where are you going with this fund? Because we spend every day on here talking about AI and Magnificent Seven, and there are other things in the world. But I'm curious, and again, the debate is where do you deploy, and avoiding AI or not having it as an integral part is perhaps the biggest risk of all. And the debate that we were having before we came up, which was, would you buy a pure AI investment with this new fund? Or how's it going to play out?
Yeah, so this particular fund, and we have a number of different investment vehicles at the firm. This particular fund is our large cap buyout fund. So we're buying mature cash flow positive companies. Like, we wouldn't invest in a pure AI tech company in this fund. Maybe our venture capital fund would. The thing that we focus on in this fund is, for the portfolio companies that we have, is AI a benefit or a threat, and how do we make sure that we take advantage of the technology to make our companies as valuable as possible?
Now, our deals team reported the other day that you were looking at IPOing Galderma. We're in this moment where stocks are at an all-time high, and we can argue whether that's fundamental or whether that is just 7 stocks. But do those all-time highs make the IPO environment more attractive? Is this the market window now to exit in that way?
Yeah, I can't comment on Galderma specifically, but I would say the IPO market generally, it's a little bit different than the overall equity market. Overall equity markets are obviously at all-time highs right now, but it's very dominated by those 7 stocks that you mentioned earlier. If it's not one of the 7, the market's a little bit thinner than what we've seen. And so in order to take a company public, you want to see the company not only price well, but also trade well in the aftermarket. And I think you need to see those conditions exist in order for the IPO market to come back.
Danny gave you gave us the data. I'm curious to know where you went in terms of the core raising in this fund, because the whole world is traveling to Abu Dhabi,
Yes.
Dubai, and to Riyadh. So what can you tell us in terms of the proclivity for those sovereign wealth funds to participate in this new fund with you? And to what extent are they still the key deliverers of liquidity at this moment in time?
Yes, our investor base is comprised of pension funds, sovereign wealth funds, different types of financial institutions. The base has been pretty consistent over time. I mean, a lot of the sovereign wealth funds that we have invested in our firm increased their commitments between the prior fund and this fund, which is why our fundraise increased in size. But
Do you see a more significant participation from the Middle East?
I think we've had fairly consistent participation over time across the different geographies. The thing that's new in this fund is the contribution from private wealth. That's an area that's a huge focus for us going forward, because I think that'll be a bigger part of the fundraisers as we try to scale our future funds.
I mean, the big picture thing here is that you've just seen huge growth. When you IPO'd in 2019, 41 billion euros under management. Now it's 232 billion euros under management. I mean, you're putting up numbers like Blackstone and KKR, and for long the criticism of them has been, oh, it's this commoditization of private equity. The creativity is gone because you're so large. So what happens to EQT now that you're so large? How do things necessarily need to change when you have over 200 billion euros under management?
Yeah, so the firm itself has 200 billion euros under management, but for the individual funds and the individual partners who are deploying it, we've been deploying capital at scale for years. I mean, even back when I joined the firm 10 years ago, we were doing some of the larger deals in the market. And so the size of deals, the sectors we're investing in, the value creation strategies have been pretty consistent over time. And so the scale of the overall enterprise doesn't really impact the amount of creativity and the value creation strategies we have to deploy in the individual assets that we're acquiring.
Let's sort of circle back and finish off with these markets and the impact that it has on flow to your world. When you see these record highs and this kind of frenzy, mania, euphoria, choose your word,
right,
whichever one you want, I just get the sense that there's more of a reason then for you to present to me as a potential customer. Are you finding it easier in this frenetic public market to deliver a cogent story on why I should participate in private equity?
Yeah, so I think, as I mentioned earlier, I think the sort of frenzy is sort of confined to a part of the universe that maybe we don't interact with every day.
I get that.
But for the private wealth, for example, are these people who would have been in the public markets and say, I don't like what's going on here, I'm going to look towards private?
Yeah, I think as you think about how our asset class has developed, people own real estate, they own bonds, they own stock. But I think particularly for high net wealth investors, having a percentage of their assets in illiquid assets like private equity is a great part of the portfolio. And because our asset class has matured and because our company is now more well known, it's easier for people to take the decision to invest in a firm like EQT.